Hello everyone, it is Sunday again, so we're going to be doing our weekly outlook on the Nasdaq. Last week I gave you this chart, and we basically said that we should expect all-time highs that week because the way we turtle dipped this low, we left this as a long-term low, plus we broke up higher, leaving these gaps open with a balanced price range, and then we had a strong reaction of this fair value gaps upper quadrant, and then there's a couple other things as well, but for the most part, everything pointed towards all-time highs being taken, and that is indeed what happened last week. So another weekly outlook in the bag. But for this week, on the daily chart, the only real level I'm going to be using is this bullish order block, and if we break through this, then I will look at this bullish fair value gap as well. But for the most part, I'm going to be using this bullish order block primarily. There will also be a weekly wick, and I'll show that to you in a moment. We'll be breaking this order block down into a mitigation block from the 4-hour, because I don't like having such a huge chunk of my chart as a PD array, which isn't going to give me such amazing support and resistance levels as if I can break it down on a 1 hour or a 2 hour or a 4 hour or even a 15-minute. It can become a lot more effective to utilize on a lower time frame, just because it's a PD array. If it was a wick level, yeah, I would use the daily wick. I wouldn't bother trying to refine that. But with a daily order block, I want to refine it a little bit more because this is actually a 300 handle range. And if you're on a 1 minute chart and you're saying at any point in this 300 handle range, it can turn around and trade higher, it's a lot more difficult to gauge where that point is going to be. Whereas if you refine the PD array and you have the idea in mind that if it's going to be bullish, it should really just respect the upper half, already you have a lot more of a refined way to deal with the daily PD array. So that's what we'll be doing in a moment. Okay, this is the weekly chart. You'll see in a moment when I go into the other slides, I'll be using this wick and I'll be using these quadrants. So this is the 2nd of October weekly premium wick. So here on the 4-hour on the Nasdaq, you'll see that we're still using similar support levels from last week's weekly outlook in the terms of this weekly fair value gap. We still have that Trump's new week opening gap. Last week's new week opening gap isn't new, and we have the 6th of October's premium wick levels from that weekly wick. We'll talk about these quadrants in a moment. For now, I want to just quickly talk about this mitigation block. So if you go to your daily chart, you'll see that that daily order block is from here to all the way around here. Now that isn't as refined as we want it to be. We want to have something that's, it's going to be more meaningful because it's not just a huge half of the chart. If we say in this half of the chart it can reverse at any single point, it's a lot harder to gauge where that's going to happen than if we refine that PD array down to something a little bit more significant. So this mitigation block is a form or a result of this long-term low, this high, and then this higher low. So a low, high, higher low is a mitigation block. The reason I'm not using an individual candlestick from the high to the low of the candlestick, I'm using this entire little period of consolidation is because this is where the majority of trading is occurring. In this consolidation, it's pretty much staying at that exact same level of this last Dankler's candle. So I'm not going to pick just that one candle. I'm going to say this entire area is that little mitigation, block. This is the chunk that we're going to consider our mitigation zone. Now, in this consolidation is where we're seeing sellers. So even in every single wick here, price is going up, it's getting sold. Price is going up, it's getting sold. Every Dankler's candle, price is going up and it's getting sold. So in this entire little chunk, we have sellers. Now those sellers, for a moment they were profitable, and then it goes against them, and now their positions are underwater. So if we're looking at scared money, what is scared money going to do? Well, they'll either hold it until it comes into break even and take it off, or they'll have their stop loss trailing so tightly, even if they're in sell positions down here, that their stop losses are going to be at this mitigation block. So there's a lot of orders resting here, and they will be taken off as a concept known as buyer's remorse or seller's remorse. In this case, it will be seller's remorse because we're looking at sellers in the market. When they're in drawdown, which all these sellers here are in drawdown right now because price is trading at 510, whereas their positions are on at around 350. For it to drop down into this mitigation block, it will let them out of their positions, and then that frees it up to want to trade higher or keep going lower. And we'll have to see what it does. But this mitigation block is strong because if you've been keeping up with ICT's new 2025 mentorships methodology on gradient levels or quadrant levels, we have that weekly wick quadrant. Now, I know ICT's only been applying it to a daily chart, but he mentioned in his X space recently that you can apply those quadrants to any chart, including a weekly, including a 4 hour, including a 1 hour, literally anything. So we're using that weekly wicks upper quadrant, and we're seeing that the mitigation block is almost perfectly, if we're looking at the midpoint, overlaying the upper quadrant of that weekly premium 6th October's wick. Now, what does that actually mean in terms of bias? Well, mitigation block isn't just an area of support, it's also an area where we can see price want to trade down into. So it's not just if it reaches here, it should act as support, it's more likely to reach here because of the positions that are here that it wants to take out of the marketplace. And if it wants to trade into this, then it would also signal that we are more likely to trade higher because it wants to unseat those sellers first and then keep going higher in the marketplace. Okay, now we're going to go down to an hourly chart. So we still have a lot of those things. So from last week, that low being taken out, it's like a tail soup, puts in this long-term low, bounce price range, keeps trading away. All this consolidation, which is actually like multiple days if you think about it. Low, high, higher low. That makes this a mitigation block. It's still a mitigation block, but I want to talk more about this one. So here, when we make this rally higher, we put in this low. It slows down a bit, trades down back below that low with a wick, closes above it, displaces higher, it leaves this fair value gap open, and it's also overlaying a new week opening gap. Now ICT also said that fair value gaps, or pretty much any PD array that's overlaying a new week opening gap quadrant level, or the entire thing, is also going to be a supercharged, what's the word he uses, supercharged PD array. And a fair value gap that's left open is a breakaway gap, which is indicative of strength. So we had that signature of strength, which was enough to take us into those all-time highs. And then from here, we've also left this 4 hour fair value gap open. Am I expecting this to be left open? Maybe, maybe not. Because short term, I'm expecting us to draw into this mitigation block, but if we open higher, I would probably just expect us to keep trading higher off this order block. So it's very hard for me to say we'll trade into this mitigation block or we'll trade into this 4 hour fair value gap without that opening price on Sunday, because if we open up higher, then I would just think we'll probably keep trading higher. If we open up lower, then I would probably expect us to trade at least into that 4 hour fair value gap and then even into that mitigation block. With that being said, I am still going to retain a bullish bias overall. It's just that short term, we may have a drop into this 4 hour fair value gap or this mitigation block depending on how we open on Sunday. Now, the reason I'm sticking with a bullish bias is because we're in all-time highs, and there is no use trying to pick the top in an all-time high because, there really is just no way of doing that. There's no methodology that covers it. There's no one on the internet can do it. And if you see it, it's usually it's always just luck. You'll never pick the correct all-time high because there's no way of actually doing that reliably, repeatably, and consistently. It's just a guess. Now, I will never say, oh, this is the all-time high, we're going to rally lower. I can say this may be a short-term high that will leave there and color into a PD array slightly below it and then probably trade higher. That I can say that. And I can see that happening, this mitigation block. It may want to drop down to this, unseat those sellers, or not unseat them, but give them a way out of their positions that are in drawdown, and then potentially use this area as a level of support to trade higher. I can absolutely see that happening. What I can't see happening, or I shouldn't try and predict, is this being the all-time high and it rallying lower all the way into these relatively equal lows, which I can guarantee some people are going to be thinking that on Twitter. Even if that happens, and you say, oh, I'm bearish, and this is going to be the all-time high of the market, and it's going to drop down to these relatively equal lows. Even if you had that prediction and it happened, it would still be the wrong prediction, because to say something like that could happen or is going to happen with a near amount of certainty, as most people on social media do, it's a very a flawed way of approaching an all-time high market. When we're in an all-time high market, the tendency, the behavior is to keep trading higher. It's like a seasonal tendency. Say if the seasonal tendency of January for the last 20 out of 24 years was to be bullish, just for example, and then you say, oh, I'm going to say this year is going to be bearish. See, that's going against the tendency of what's supposed to happen. So what's supposed to happen in an all-time high market is we should just retrace, trade higher, retrace, trade higher, retrace, trade higher. And then eventually we'll have, a landslide lower. But to predict that is extremely difficult and, pretty much impossible. ICT says that he can't do it. I'm not going to sit here and claim that I can. I'm not exactly better than ICT. But I'm going to try. Anyway, to see this be an all-time high and then drop lower, very unrealistic. Short-term expectations, potentially trade into the mitigation block, but don't hold me to that. Because if we open a bit weirdly and we just open up higher, it could just run through that gap and keep trading higher because we do have a bullish order block here. Plus, the reason I, again, don't think we'll have a deep retracement is because this 6th October weekly premium wick high, that is also known as the all-time high level. This was all-time highs. This is an hourly chart. We trade through that high with a fair value gap. So we've left a 4-hour and an hourly fair value gap there, which is usually a sign that we'll just, this is strength. It's just going to probably keep trading higher, keep trading higher, keep trading higher. How far higher? I don't know. I can't sit here and tell you I do, because there really is nothing to go off regarding liquidity pools that we may reach into or imbalances that we may look to, seek to balance. It's just an all-time high market. There's nothing more here printed on the left. It's just blank. We have to let it print out because it's in what we call a discovery phase, where it's discovering its new range, and then it'll, put the brakes on that, trade lower, and then we'll be able to participate in shorts again. But for now, in an all-time high market where we're expecting it to trade higher and higher and higher and higher, you don't want to be selling. You want to be letting it have its drops down, and then you want to be buying those up into all-time highs. So, say Sunday has a higher open, I would potentially, if the right conditions are present, look to buy off maybe this hourly bullish order block and go into the next all-time high, maybe a bit more. So that is pretty much the weekly outlook this week. There's nothing super special because we are still in an all-time high market, as we have been for a very, very long time. So we are forced to operate under a bullish bias. It doesn't matter what I'm predicting, what I think could happen. I will always operate under a bullish bias in an all-time high market because that's how you prevent yourself from getting burned. That's how you, that's how you protect your equity, rather than trying to predict a sell-side delivery move. You just let it happen, and if it happens, it happens. There's nothing you can do about that, and there's nothing you want to participate in because in a sell-side delivery move, when that's happening in an all-time high market, it's very possible that at pretty much any point it can just turn and rally higher back into all-time highs. That's why it's so dangerous to try and sell in an all-time high market. Those are very, very low probability ways of trading. So you want to align yourself with just buying, just buying, just buying. Let it drop, buy up, let it drop, and buy up. That's pretty much the main strategy you should be approaching an all-time high market with. That is going to be it for this week's weekly outlook, and I'll see you in Discord tomorrow morning. Goodbye.